If you've been watching the news lately, you've likely been inundated with all sorts of financial information, with the banking industry continuing to be the leading topic on the news. Silicon Valley Bank, Signature Bank, and First Republic were all names that many people were not familiar with just a few months ago. And now all those names seem to be dominating all of the headlines. Just take a look at the Wall Street Journal from March 21st. This is a list of all of the articles just on the front page that talked about what's going on in the banking industry. As if that wasn't enough, the Wall Street Journal actually created a banner at the top as a one-page, one-stop shop for all of your banking concerns. Understandably, I think this has caused a lot of people and clients to ask some questions. What is going on? Is this something that I should be worried about? Because it seems to be all over the news right now. And if it is something that I should be concerned about, what are some of the things that I should be thinking about? What should I be doing? We hope to provide some answers and context to those questions today. Hi, my name is Matt Abels, Chief Practice Officer here at Foster Group. To answer those questions, we plan to have two different conversations. Today, we'll be joined by Michael Westphal, Director of Investments here at Foster Group. Michael will give us an overview of what's happened in the market, what's contributed to some of the volatility that we've seen the last 3 or 4 months, and some of the implications that the banking news has had most recently. And next week, we're going to be joined by Jim Plagge, President and CEO of Bank Iowa. He'll be here to go over a little bit more in depth about what's happening in the banking industry, the state of the banking industry as a whole, and what are some of the things that consumers should be thinking about. But today we wanted to get started with an overview of what's been happening in the financial markets, and for that we'll bring in Michael. So Michael, it's been a challenging few years to be an investor, to say the least. Just going back over the last 5 years or so, we've seen 3 pretty significant events that have happened. If you go back to 2018, there's a lot of tension going on with China, trade wars. 2020, pandemic, election years. 2022 brought on a whole new set of challenges with high inflation, war in Russia and Ukraine. Can you just give us an overview of what's been going on in the markets the last, say, 12 to 15 months, and maybe what are some of the implications of that?
Sure. So, firstly, looking here, over the past year, we've seen, a pullback and increased volatility in the global equity markets. The Fed has been raising interest rates from the beginning of 2022 to try and combat that inflation. Inflation did peak at over 9% in June of last year. But right now we've got fears of a recession, still kind of high inflation, and an aggressive Federal Reserve. The markets are down 10 to 15% over the past year. So overall, we're looking at a turn that we've seen recently. In the fourth quarter of 2022, we got a nice little bump that continued into January of this year. We had good news in GDP, and it looks like we caught a turning point in inflation that led the markets to go broadly higher. But unfortunately, we saw some volatility return in February and March. The Fed's rate path, at the time pointed higher with the strong employment numbers that we received. We also have some inflation that just keeps hanging around. Yeah. Not only that, we saw corporate earnings growth go negative for the first time since 2020. And as you mentioned, recently we've seen that volatility coming from the regional banking industry. Moving over to interest rates, short-term interest rates have just increased at a historic rate. Intermediate and long-term rates have increased by quite a bit over the last 15 months too. The short end of the yield curve in particular is up 4 to 4.5%, which is why we saw negative fixed income performance last year. Moving over to inflation, the primary reason for these rising interest rates, inflation has been trending lower, as you can see there, but it's still coming in right around 6%. That's better than the 9% we saw last June, but really it's well above that 2 to 3% target the Fed would really like to see.
Okay. Well, it's interesting. If you think back for the last, say, 12 to 15 months or so, a lot of the information and the headlines that we were reading in 2022 really had to do with inflation. And because we started to see that turn, like you mentioned, we saw a good bounce back. And I think a lot of us and a lot of our clients were hopeful that what we were experiencing in Q4 and kind of the first part of 2023 was hopefully a sign of good things ahead. And then we saw things shift a little bit the last month or so. And that was largely due to a lot of information about a few banks that got a lot of attention in the headlines. Many banks, though, that a lot of people hadn't heard of before. So can you explain to us a little bit more about Silicon Valley Bank and Signature Bank and kind of what's been going on with them?
Sure. So firstly, Silicon Valley Bank, they are, as kind of the name suggests, headquartered in Silicon Valley and cater to venture capitalists. I think about half of the venture capital backed money was in Silicon Valley Bank.
Okay.
About 18 months ago, they were a $40 billion bank by market cap. Before all of this turmoil, they'd trended downward. They were closer to 16 billion. They were, one of the top 20 largest banks in the country before everything happened. And then if you look at Signature Bank, their client profile, they had a lot of crypto clients.
Okay.
So as some of this turmoil has been happening, the fear in the crypto space led to some concern about them as a bank as well. So those are kind of the two banks that we've been hearing a lot about lately.
And can you just walk us through what happened to those banks? And we've been hearing a lot about bank failures. Can you explain kind of the implications of that for investors?
Yeah, so these banks did fail. The FDIC has taken them over. And so what happened was that the shareholders were wiped out. The stock prices effectively went to zero. So anyone who holds the stock in these companies took a loss. The fortunate thing for our clients, they were in the portfolio, but they were very small weightings in the portfolio. They were large cap stocks before all of this happened. They were in indexes like the S&P 500, but they were a small component. Overall for our clients and pretty much anyone in a well-diversified market cap weighted portfolio probably saw something like 0.05% of the entire portfolio in these banks.
So relatively small
Yeah.
allocation.
Yeah.
Okay. So, a lot's been made of the role that the FDIC has played in protecting the depositors. But I think what you mentioned is that, but as owners, they were kind of wiped out as stockholders. But our exposure is relatively small. I think a question, though, that some investors might be asking is, how often do banks fail? And what was the cause of these two failures?
Banks fail every so often. In certain environments they fail more, but this is the first few that we've had in the past several years. There are a few reasons for these failures. The primary reason, though, would probably be the mismatch in they borrowed short from depositors and they were investing in slightly longer securities, something like 2 to 3 year treasuries or mortgage-backed securities. And as the Fed was raising interest rates, the value on those securities went down. And a lot of people came and asked for their money from the bank. And really any bank, if every single depositor came and asked for their money, there's not a single bank in the country that could handle that all in one day. So it just so happened that these banks had a small enough client base that they talked to each other and came and asked for their money, and they weren't able to accommodate that.
Well, at the same time was the problem with that.
Yes.
One, right? I think it's tempting when you see all of that to, at least those of us that were investing and doing this in 2008 and 2009 will never forget how we felt during that time. And I think it can be tempting to compare what we're experiencing now to maybe what the financial industry was experiencing in 2008 and 2009. Are there any similarities to what happened with these banks to what some of the banks were dealing with back then? And is there anything that we should be concerned about going forward?
So, not as many similarities. The big difference here is that back in 2008, 2009, that was a crediting issue. Now we're talking about really a duration mismatch issue.
Okay.
So, it's a liquidity issue. It's a timing issue. That's the biggest difference right here. And I have a lot of faith in the U.S. banking industry right now. So, no concerns from my end right now.
Great. And we'll certainly have Jim speak a little bit more about that next week. So I think we all understand the role that banks play in safekeeping our cash. I think another question that we've gotten recently is, what's the role of a custodian? And are the assets that are there, are they safe? Charles Schwab, for example, has been in the news quite a bit lately because of some volatility within their own stock price. Can you walk us through a little bit about the role of a custodian? And is there anything that investors should be thinking about as it relates to their assets that are held there?
Yeah. So the first thing I'd say, about custodians like the ones we use, such as Charles Schwab, they are in a stable and sound financial condition. The way a custodian works is if you put money in there or you have assets there, that is your money. Those are your assets. They belong to you. The custodian is simply flagging whose is whose and holding them for you. They are not lending them out like a bank is. Banks take your deposits and lend them out to someone else so that they can buy a house. A custodian isn't doing that. Right.
So, we covered a lot there. So maybe just to summarize, despite what we're seeing in the news, and again, we talked about that Wall Street Journal headline where there was, 7, 8, 10 different articles just today about all the things that are going on. The general sentiment is that, the exposure that our clients have and investors have to these banks is relatively small, as investors anyway, and that the general sentiment about the banking industry is pretty sound going forward. And again, we'll certainly have Jim speak to that a little bit more. And if we want to think about the comparisons between 2008 and 2009, the issues that the banks are dealing with today are just very different than what they were dealing with back then.
Very accurate.
The last month has really reinforced the challenges investors face in today's information age. For some, navigating that information can be extremely challenging. I think it's important at times like this to take a step back and reflect on what we've learned in the past. Because when you look at the past, you'll see uncertainty is certainly not new. We've been dealing with that forever. Just over the last 50 years, these are just some of the most impactful headlines that we've seen. These events or headlines, when looked at in isolation, could have led investors to question what to do next. To ask the question, is this time different? To illustrate that point, if we go back just even 5 years, if I would have asked you, in the next 5 years, here's what we're going to go through. We're going to see increased tension with China. That's going to lead to a trade war. We're going to go through a global pandemic that will shut down our economy. A war in Ukraine and with Russia. Inflation we haven't seen in 40 plus years. Along with that, we're going to go through banking issues and bank failures. If you knew all of that, would you want to invest for the next 5 years, or would you rather sit this one out? Well, the fact is had you invested 5 years ago, this is what the index returns would have been over that period of time. Despite all of that, it's been very positive. Does not mean that this has been fun, does not mean that it's been easy. But for those that have been patient and stayed the course, they've benefited from that. I'll close with this. We've been through tough times in the past, and we've been through tough times, and we'll go through tough times in the future. It's how we navigate that stress, how we sift through those headlines that often is the difference between a positive and negative investment experience. I think of investing kind of as an endurance sport. It's a marathon, not a sprint. I think it's incredibly important that investors are patient at times like this. Be mindful of the headlines. They often don't tell the full story. And as always, if you ever have any questions or concerns, don't hesitate to reach out and give us a call. And please join us next week where Jim Plagge, President and CEO of Bank Iowa, will be joining us to explain in more detail what's happening with the banking industry and some of the things that we should be thinking about going forward.